Modern exchanges are very similar to those in the 1800s. Today, traders still work in pits, with each pit handling one or more commodities. Traders face each other and use open outcry to communicate transactions. The Chicago Board of Trade is still the largest commodity exchange in the world, handling wheat, corn, soybean, T-bonds, and other goods. The New York Mercantile Exchange is also extremely large, handling gold, frozen orange juice, coffee, heating oil, and crude oil. Traders in the pit are members of the exchange. Non-members have to conduct trades through brokerages who do have membership. Additionally, today's commodity exchanges have strong relationships with clearinghouses. Clearinghouses serve to capitalize the exchange, and they provide a means of settlement for contracts. Additionally, they act as counterparties and set margin requirements for contracts written through the exchange. Commodity exchanges trade futures contracts. These modern futures have some of the same properties as their predecessors. Namely, they have a finite lifespan and are standardized to allow for easy trading. Individuals or companies will trade futures to hedge risk and to speculate. One party will take the long position, meaning they'll buy the commodity for a specified price at a given date. The other party takes the short position, meaning they'll sell or provide the commodity in return for the price specified in the contract. The value of futures contracts fluctuate greatly. First, the value of the underlying commodity can change from the value it had at the origin of the contract. Additionally, seasonal influences and unexpected events can alter the supply and demand for a particular good. In the case of bond futures, the actions of central banks can impact interest rate movement. For example, the Federal Reserve or the European Central Bank can raise or lower its prime rate. This impacts the value of bond futures. Ultimately, futures prices reflect the current cash price of a given commodity, plus the market's expectations for future price movements. Even though futures contracts are for physical goods, most contracts are settled in cash rather than the owner actually taking delivery of the commodity. Let's look at an example to see how this works. Let's assume a baker needs 200 bushels of wheat in August, and right now it's May 2008. The baker will purchase a future. He'll get 200 bushels at today's price, $750 per bushel. The contract has a total value of $150,000. Now, with futures contracts, gains and losses are debited and credited at daily mark-to-market prices in a person's account. Parties who need the physical commodity will purchase it in the cash market rather than exercise their contract. So in this case, the baker will settle the contract in cash. In August 2008, the new spot price is $820 per bushel. This means the new contract has a value of $164,000 versus the original value of $150,000. He'll settle the contract and receive $14,000 in cash. Now the baker will actually purchase his wheat in the cash market. He'll purchase his 200 bushels for $164,000, but when you factor in the $14,000 he received for the contract settlement, he's still paying the original price in the future, $750 per bushel. Brokerage firms carefully monitor contracts nearing their expiration and inform the owners that they need to either close their position or prepare to take delivery of the commodity in the contract. If the owner doesn't want to take possession of the commodity, he has two options. First, he can sell his long position, or conversely, he can sell short positions, meaning he promises to sell the commodity that he's taking receipt of in the long position. Now I know this sounds convoluted, but this is how traders in the market typically operate. They generally prefer to sell short positions rather than sell the long position they have. Now, if for some reason a trader does decide to take possession of the commodity in the contract, he'll usually receive a notice telling him where he can pick up the commodity at a warehouse sponsored by the exchange's clearinghouse. Commodity futures are attractive to both investors and speculators. As we've talked about before, investors like futures because it gives them price certainty and allows them to hedge. Speculators also enjoy commodities because of the many options and derivatives that are traded around them. Additionally, futures prices move much more quickly than stock prices or real estate, so it's easier to generate returns more rapidly. Also, commodity trading allows speculators to operate in a more leveraged environment. Most derivatives around futures require 10 to 15% margins versus almost 50% for stocks. Finally, there's the view that it's harder to trade on insider information in the commodities market, meaning that it's easier for speculators with accurate predictions to make money. This makes sense because commodities are traded in an open outcry fashion, whereas stocks are traded electronically most of the time. When you combine low commission charges with a broad and liquid market, it's easy to see why speculators and investors are attracted to commodities. In our next discussion, we'll look at the recent capital inflows into commodities and try to understand what role investment, speculation, and inflation all play in the rise in commodity prices around the world.